and it's the Money Smart Show for April 27th, 2024. My name is Brian Johnson. I am the President and Portfolio Manager of the Moon Run Report. We have a disclaimer here. This talk on portfolio management and drawdown control is designed to educate investors to identify clues to the market based on stock market data. There is no guarantee that any signal will be timely or accurate. Investors should be aware that the analysis here is designed to inform, not avoid all losses that might be incurred. Past performance does not guarantee future results. So on the status of the market, we are bearish, and here is why. We entered a shortable correction signaled on April 10th, just a few weeks ago. The rate of decline, which measures how fast the market is falling, it is a correction less than 190. If it was more than 190, then the market would be stalling out and might be reason to be in a tsunami indicator signal, but not so. Normalized new lows at greater than 30 at the top. Normalized new lows greater than 60 at the sell signal at the top of the market. Before I get it's a signal to sell, that's when I look at it, and we have both concurrent signals. Accelerating new lows calculation. This measures how fast the market is falling, and it is falling at a greater than 40%, which means it's true, and everything is true. So we are in a shortable correction, and we are forecasting a 10 to 20% drop in the market. Now, not 2 days ago, but on Thursday last week, we're down 8.5%. Maybe that's the bottom, but I kind of doubt it. Well, if this turns out to be a reverse and go back up, we'll see. But actually, the market is strong and it's weak. It's splitting apart a little bit, and we have a different situation. Here is the signals, the indicators that we have. The Russell 2000 is here. Wait a minute. Let's go back. We have the indicators here based on okay, we're going to show that the market is in strength. The market strength indicator is near 3.8 at this time, and we are looking at a continuation of the shortable correction. Here is the confidence index. As you can see, down below is the NASDAQ confidence index. It is actually turned bullish a little bit on Friday, but is very close to the moving average, and it's undecided as to whether we're going to go back up again here. The New York Stock Exchange confidence index here is bullish, but we have a close reading. It's narrow to undetermined as to whether we're going to go back up again or going to go back down. So we are watching this closely. But here's the signals. The internals are falling apart. As you can see here, in this area, we have the NASDAQ internals signal crossing the moving average down, and we have a bearish situation here, and also the New York Stock Exchange. So they're both defensive at this point. So we continue to watch the bear market, the bear mode, and hopefully we will have a signal coming up soon and determine what's going to happen. The Moon Run Report and how you can use it. Okay, this is what I have to offer in the website. Okay, $10 a month. First month is free. The intent is to invest in proven portfolios to generate high returns, sell out before a bear market hits, and buy after a bear market is over. My track record: world champion 2008, runner-up 2009, and bond timer of the year 2019. You can read the rest of it. I believe in next week, we're going to have a 3-year track record for Holbert Financial Digest. I should be number one. I'm way ahead in the 2-year and 11-month period versus everybody else's 3-year period. So I expect to be number one for the 3-year period, trailing. So we'll see. What Moon Run Report contains? 7 different portfolios: small cap, minor cap, mid cap, large cap.
I got a question here. Can you go back to previous slide. Most people don't understand what the Hubert Financial Digest. Can you expand on that? What it is?
Yes, they've been in business for years. They track 15 or 16 different websites or newsletters presently. Then they have a ranking. You can look at it. They don't particularly rank in that order, but you look at the numbers, and what you look for is the Sharpe ratio, performance versus risk, and they do a calculation. And this last 12 months, I was number 2. Having a Sharpe ratio just below the top. And I believe in the next 3 years, for the trailing 3 years coming up in next week, I will be number 1. But does that answer your question, Matt?
Yeah, great.
Okay.
This is something we're going to share with everyone.
Right. What the Moon Run report contains. Okay, the portfolios, and we have portfolios on Portfolio 1 designer models, some 10 stock portfolios and some 50 stock portfolios. And then we have charts describing the indicator for the market direction on my Moon Run report website. Bear market signals when they come out, when they get back in the market, and we have weekly updates on Friday nights. So if we need to sell a stock and replace it, it's on Monday mornings. Not very often, but it happens. And then first month free, $10 a month thereafter. Okay, here is a little examining the portfolios that I have for timing. Small caps, okay, these are $15 million to $250 million market cap. Back test from 1999 to 2024, almost 50%. That's pretty darn good. Maximum drawdown is 36%. And so that's what we have. A small cap portfolio, 10 stocks, and they do very well. And here's a chart of how well it's done since 1999. Minor cap, just between small cap and mid cap, we have a selection of stocks that perform very well also. The back test from 1999 to 2024 is 24.54%, and a nice small drawdown of 25%. And we look for 500 million to 2 billion market cap. Okay. And that's what we're looking for. And here's a chart of how well it's done since 1999. Mid cap portfolio, back test from 1999 to this year, 25.73%. Pretty darn good. Maximum drawdown even less than the minor cap portfolio, and the small cap is 18.84%, and a turnover rate of about 10 stocks a year. And here's a chart of that portfolio since 1999.
That's a big jump. Yeah, from 2015. Yeah.
A large cap portfolio, back test from 1999 to 2024, 23.87%. That is not too bad at all, you know. Max drawdown of 26%. That's reasonable. Turnover rate of 138%, so a little bit more than 10 stocks, maybe 13 stocks a year. And we look at the Russell 1000 for that. And here's a chart of that. So we have a back test and currently. Altogether, combine the portfolios, you get 31.96% average compounded growth rate. So that's pretty darn good. Maximum drawdown of 20%. And here's a chart of what happens when you put them all together. How much 100,000 invested becomes in 10 years? Okay, you have various different, as you can see, substantial gains in any portfolio that you put into. Combined, it's 1.6 million for all of the portfolios. 15 years, as you can see, $100,000 becomes 6 million in 15 years, 6.4 million end result, using 31.96%. So that's not too bad. On YouTube, we have these little videos called No One Calls Bear Markets Like Brian. The 2-minute YouTube videos describing the features of the book Before the Bear Strikes, Moon Run Report, and the Money Smart Show. Go to YouTube, and in the box, you put Money Smart Show, and you will find a lot of videos. And from 1987 to the present, bear market calls and back tests. And there you go. Okay, today we feature the large cap portfolio, no timing model, which is on the Moon Run Report website. I just designed this a few weeks ago. It is just outstanding, 24% a year, and it was so. Wouldn't it be nice if there was a straightforward way of designing a large cap portfolio? Okay, I wanted simplicity, and that's what I got. What will the factors be? And I'll show you on the next slide. Buy rules. Okay, annualized returns. Return on equity greater than 0 for at least 3 out of the last 5 years. Now, usually analysts look for return on equity greater than 15, but according to my back test, I get really dandy results with it just being above 0 for that 3 out of the last 5 years. Annualized growth margin, okay, how much they charge per product. Greater than 5. Usually analysts look for 30 for 3 out of the last 5 years, but when I looked at it, by golly, you need 5, just need 5. And current ratio is the star of the show. Current ratio measures the strength of the piggy bank of the company. If the piggy bank is healthy, the company is healthy. It measures current assets divided by current liabilities. And with a greater than 2, I mean, this thing just shines. So 3 of the last 5 years. Annualized free cash flow per share. This does good too. 0.5 for 3 out of the last 5 years. This adds volumes to the portfolio. Price greater than 5 and average volume for the stock selection greater than 1 million for the past 50 days. Sell rules. Trailing stop of 25%. You need wiggle room in the portfolio to do this. So this is what I do. And the initial stop of 20% is what I have, just to make sure it doesn't fall too fast after you start. Statistics. Compound average growth rate, 23.81%. Okay, that's not really good. Long only, no timing. Sell and replace every time. Turnover rate, 72.41%. That's not too bad, considering we had larger turnover rates for the models that I had previously that I showed. Maximum drawdown, 50%. That is less than the big colossal breakdown in 2008. I look at the S&P 500 and 1 million shares traded. Here's a chart of the portfolio. Okay, from now on, the rest of the show, I'm going to go over my research and how I call bear markets. A mystery no more. I used 16 years of research and live testing. There are 4 setups for bear markets. Each setup was invented with a concept, and that is where it starts. You need a concept. You just can't play around with indicators and get it. You just don't. So each decline was identified by market weakness, which is measured by the market strength indicator going below 3.8 at the sell signal. So that is necessary for every the colossal ones. And the metrics identify different setups. The setups are tsunami indicator, the 50 new lows rule, accelerating new lows, and shortable corrections. Now, shortable correction does not need the market strength indicator to go below 3.8, but for the other 3, yes, it does. 4 signals. Tsunami indicator. The market stalls out and the internals start falling apart. What happens when the market stalls out is that people can't push the market higher and the market goes sideways as measured. And the internal starting apart is measured by the market strength indicator, which I use. And if it goes below 3.8 at the sell signal, then it's time to look at it closely. 50 new lows rule. The number of new lows is extremely high at the top. What happens is usually when the market goes up, the number of new lows goes down. But in this case, what happens is the market goes up and the number of new lows goes up. And that means that the market is splitting apart. Accelerating new lows rule, the market starts plummeting. Get out. This happened in 2020, the COVID crash, and also 2009. The shortable correction, this category covers everything else, usually a 10 to 20% drop, and not necessarily a bear market. Chronology. In 2005, what's that? Yes, go ahead.
Yeah, which can you go back to a previous slide? Which indicator that you actually see that flagging right now?
It's the shortable correction. Yes, I do not expect it to be a bear market, but usually we get results that where you can buy puts and make money that way. So, anything else?
Oh, that's it. Thank you.
Okay, good. Chronology. The 2005 tsunami indicator was invented. And then in 2008, it was used for the first time and it won the World Cup that year. 2013, the 50 new lows and accelerating new lows were invented. So that was our first starting point. The 50 new lows rule has been successful ever since then, and the accelerating new lows had to be corrected after that. The 2014, the shortable correction was invented, and both of the accelerating new lows and the shortable correction had to be revised, and I believe going forward they should be successful. And in fact, the shortable correction has been successful. We are waiting for the accelerating new lows signal to be used. So preliminaries. Okay. Normalized new lows. This is a mathematical equation to make sure that through the years, the new lows reflects the true nature versus how many issues there are in the market. So if you have a few number of issues in the market, you get a few number of new lows, and we multiply that by 3,000 to correct it and get all the things correct. Rate of decline. Okay, this shows how fast the market is declining. The rate of decline is the X over Y calculation, not Y over X, okay? And we see how fast it's dropping. So we have different numbers for each correction, each bear market model. The rate of decline has to be greater than 190 for the tsunami indicator. It's not used for the 50 new lows rule. Less than 100 for accelerating new lows. This one is the market's just taken off on the downside, and you got to get out. And the rate of decline less than 190 for the shortable correction. Market strength indicator. This is a sum of 4 metrics. We use advanced decline, up down volume, new highs, new lows, IWM price, and 25 divided by the VIX. Since the VIX is inverted, it's strong when it's market's strong when it's low and market's weak when it's high. So we divide 25 by the VIX. And the market strength indicator greater than 4.5 at the market top before the sell signal means a strong market. Market strength indicator greater than 3.8 at the sell signal means a strong market too. We're looking right now, the market strength indicator is just around 3.8, not really signaling strong or weak. So we have that situation. The tsunami indicator. At the time, the short to intermediate market timer gives us candidate sell signal. The tsunami indicator is activated when the rate of decline greater than 190. Okay, the market stalling out. Number of new lows at greater than 40. Now I have taken this out because the market strength indicator takes care of that, and we no longer need the normalized new lows straight at the greater than 40 of the sell signal. The market strength indicator is less than 4.5 at the top, less than 3.8 at the sell signal, meaning the market is weak. And the VIX is between 19 and 25, the sweet spot. Here's an example. Okay, as the metrics here show that it is actually successful. 2008. Here is where the sell signal was generated. As you can see, a big colossal crash in the market, and following by a time to cover your shorts if you were, but not buy. Okay, so this is an example of what happened, and I won the World Cup that year. 50 new lows rule is the 50 new low will show that the market is splitting apart and unsustainable. Normalized new lows greater than 50 at the top. Okay, this is a general use by observation that I looked at. The rate of decline is not used because we don't need it. The market strength indicator less than 4.5 at the top, less than 3.8 at the sell signal, and the VIX is between 19 and 25. Here's an example. March of 2000. Okay, all the metrics line up. We have a comparison, and here's the chart. Here's the sell signal, a big bull market in the internet stocks, and all of a sudden they crashed. And this is what the start of the big crash of the tech bubble, which lasted 2 years or 3 years. Okay, so 50 new lows rule here, and then we get a buy signal to capture the next rally, which went on beyond this. Okay, so that's an example. The PEP indicator came in that too. The accelerated new lows rule. The accelerating new lows rule determines when the market is falling at precipitous speed. It's really going down fast. The rate of decline less than 100, the VIX greater than 23, market strength indicator at the sell signal less than 3.8. Now notice that I didn't show the at the top less than 4.5 because it doesn't matter at this case. What happens is after we hit the top and this market the market just starts dropping fast. And an accelerated new lows calculation greater than 50%, which means it's just in dire strait. And here's an example in 2010. Okay, accelerating new lows at this time, accelerating new lows at that time, and the time to get in was over here. Now, the idea was to stay out of this, and this signal here, it's a buy signal, says we do not trade this rally. It's just not working out. Not only that, the market got blasted here, and so that's the idea. So at this point, the market is we go out and we get into the market at this point. Okay. Shortable correction. Shortable correction is used to identify everything else. The normalized new lows at the top greater than 30, accelerating new lows at the sell signal greater than 60, accelerating new lows calculation, which shows how fast the market is dropping, greater than 40% as the number I use, and the rate of decline less than 190. And here's an example of that. So the 2015, the debacle, it lasted from June 29th of 2015 down to March 1st of 2016 next year. So it took about a little more than half a year. So anyways, and here's the start of something bad. If I fail to call the bear market, okay, if the Russell 2000 goes down 20% and I didn't catch it, we sell everything. Do not argue. And here's a special case, the minor sell signal. The minor sell signals are a time that I will accept that the market will go down and lose money, and I will lose money. These never turn out to be a bear market, and they may be scary. That's the thing. So corrections are scary, but usually what happens with the bear market signals that I have, they kind of start out really slow, and you don't expect. So getting back in the market, here's what we do. Characteristic of bear market bottoms. The short to intermediate market timer gives a buy signal. The PEP indicator needs to be above 3.8%, which shows a strong pulse in the market. That's what we want. And this is after everything's collapsed. So we look for a buy signal at that point. The calculation is found in the book Before the Bear Strikes. Okay. It's a smoothing, and we use a comparison of price and volume, and is a calculation of price and volume. So that's where I look. The following chart shows a PEP indicator that failed and a PEP indicator that was successful. Okay, this is at the end of 2008. We have this, the market came down really hard in the real estate crash, and the market went back up here in December 12th. We got a buy signal. But what happens is that the PEP indicator, the calculated PEP indicator, came in less than 3.8%. It was 3.09, and it did not confirm the rally going. As you can see, it was short-lived, okay, not just a few days. And then all of a sudden, this is the January, we got a sell signal, and it turned out to be an accelerating new lows, and the market just really went down. Next time we have a PEP indicator, okay, this time the reading was 13.17%, greater than 3.8%, and it confirmed that this idea. So that's the end of that show. We have Matt. Do we have anything to add? Do you have any questions?
Yeah, I do have a question. I've been following up the market, and I've seen multiple people comparing today's market to 1987 because the bond market crashed. So I wonder if you have a chart on 1987, which is actually, you had a amazing accuracy on that one. Do you have a chart to show the indicators that flagging the short signal?
I will bring that up if I can.
You have to share the screen again.
Well, you know, I don't have these things listing as the name, so I just can't have that today. Sorry about that, Matt. I just
no problem. We can touch on that next week. Yeah, this is really fascinating. So, you know, one question I have is that it's all about tracking, analyzing the back history of all the patents, right? I guess in this case is financial patents. So I wonder if AI can help to do some of the jobs to make it,
Well, even AI needs help with concepts. It does. I've seen analysis by AI, and you just have to step away from that type of thing. And from what I've seen, you get basically a analysis by what would a normal analyst would say, do your own research, that type of thing. And I'm just not a fan of that. So anyways, can we end the show today, Matt?
Yeah. Thank you. That was great. Yeah.
Okay. So Matt, that's the end of the show. Thank you everybody for showing up.
Thank you. Check out subscribe to our Money Smart Show YouTube channel as well. Thank you.
Okay. Bye-bye.
Bye-bye.